Listed investment companies have been around for many years, in fact in the case of AFIC over 80 years. So they're quite well known in the marketplace.
Well, listed investment companies are pooled investment vehicles that were structured as companies rather than as trusts.
LICs are like any other company, like a BHP or Woolworths. They have their own separate boards, their own governance structure.
They allow people to have an investment in the share market across a portfolio of different companies.
They're listed on the ASX, so you buy into that investment through buying shares on the ASX.
They're very similar to other managed funds in that the pooled investment vehicles professionally managed a range of investment strategies. But there's also a number of differences. And one of the major differences from listed investment companies to managed funds is that listed investment companies, or LICs, are a closed-ended vehicle.
LICs are closed-end funds, basically because they have only a certain amount of funds available to invest. The amount of funds available or number of shares on issue is determined by the board. So in a sense, if the board decides to issue more shares, then more shares come to the market.
When an investor makes an investment in a listed investment company, they buy or sell units on the market. That trading of those units doesn't impact the size of the overall portfolio. In the case of managed funds, if an investor makes an application or a redemption, that will impact the size of the underlying portfolio as it's creating new inflows or outflows.
There's approximately 60 LICs listed on the ASX. A number of those have been around for many years.
There are really two major categories. The older ones tend to take a longer term view to their investments, whereas the ones that are more recent, that are set up in conjunction with fund managers, they tend to have a higher turnover of the shares that they invest in and have a shorter term focus.
There's quite a range of investment strategies that are now available. There's smaller mid-caps, there's micro-cap strategies, there's long-short strategies.
It's really up to the fund manager to decide where his investment universe can be.
There's even managers that invest within global equities and specific sectors, including global resources.
I think they've grown substantially over the last few years because fund managers are quite attracted to the idea of having a closed or fixed amount of funds to invest. So that gives them the ability to actually invest for the long term without having to worry about inflows and outflows of funds for investors sort of change their mind because of different cycles within the market.
The investment company structure is a closed-end structure, which means we don't have redemptions on a regular basis. We're not out issuing new units to try and bring money into the fund.
Now from an investor's perspective, clearly if they're looking for returns over the long term and also with a profile that probably has a little bit less risk in it, they won't have to worry about the fact the fund manager's panicking about trying to outperform in the short term. Defined unit trusts trade at the value of the underlying asset within the portfolio because they're open-ended funds. An LIC, because it actually has a set amount of shares on issue, sometimes can trade at a premium and sometimes can trade at a discount.
So managed funds are always priced on the value of the underlying portfolio. Listed investment companies, on the other hand, are impacted by the demand from buyers and sellers within a market.
The share price of a listed investment company versus its net asset backing is an important one for investors to understand. We value the portfolio, which means looking at all the things we invest in and valuing them at their market price, and then divide by the number of shares that we have on issue, and that's the asset backing of the company. You then compare that to what the current share price is, and you can compare the share price with the net asset backing. And in some cases the share price is above the net asset backing, and we call that a premium, and other times it's below the net asset backing, and we call that a discount.